Today we are going to cover the statement of profit or loss and other comprehensive income from the June 2019 ACCA FR question. Before we go on, if you haven't subscribed to my channel, please do so now. Now let's look at the question. Here is our question paper, Financial Reporting, FR March-June 2019 sample questions. Now let's go to the question that we will be answering today. Today we are going to be answering question 32, which says, let's go to the required, produce a statement of profit or loss and other comprehensive income for Vernon Co for the year ended 31 December 20x8. B. Calculate the earnings per share for Vernon Co for the year ended 31 December 20x8. We are not going to be covering part B, we'll only cover part A together today. Now let's go to the scenario. I encourage each and every one of you to open the required template. We are here told that we have to prepare the statement of profit or loss and other comprehensive income. So the exam technique first, you have to open up the required accounts. So I have already gone ahead and opened the required template for Vernon Co that we will be using to answer our question. So now, going to our question, we are given here, the following extract is from the trial balance of Vernon Co at 31 December 20x8. We are given the cost of sales, the finance costs, investment income, operating expenses, revenue, and tax. We are given those figures. So we don't want to waste time. We have to take all those figures to our template. Let's do that. Cost of sales is 46,410. So we go to our template. We come to our cost of sales. We say 46,410. Finance cost 4,050. We go to our template where there is finance cost, we put 4,050, awaiting some adjustments. We go again to our question, investment income 1,520. So we go to our investment income 1,520. Then we copy again, operating expenses 20,640. So we come to our operating expenses 20,640. Then we come to revenue 75,350. We put our revenue is 75,350 like that. Then we have got our tax. Our tax here is a debit. This column is debit and the other column is credit. Our tax here is a debit of 130. A debit of 130 means an under provision of the year 20x7. So it will be an expense in 20x8. So we come to where we have our tax. We'll add the under provision of 130 like that. So we have now taken all these figures from the trial balance. Now let's go to our notes. So the exam technique, you have to work note by note, opening a working for each and every note. Now let's go to note number 1. Note number 1, we are told here, Vernon Co made a large sale of goods on 1 July 20x8, which was also the date of delivery. Under the terms of the agreement, Vernon Co will receive payment of 8 million on 30 June 20X9. So Vernon Co will receive the payment of 8 million 1 year after the date of sale, which is the date of delivery. So this again is an investment because now Vernon Co has to finance this sale for a year. Currently, Vernon Co has recorded 4 million in revenue and trade receivables. Why Vernon Co has recorded 4 million? Because the sale took place in 1 July 20X8. So Vernon Co has said July, August, September, October, November, December, which is 6 months. So Vernon Co has said 6 months, 6 out of 12 multiplied by 8 million. So he has recorded 4 million, of which is wrong. We'll record the correct sale. The directors intend to record the remaining 4 million revenue in the year ended 31 December 20X8. This is also wrong, incorrect. The sale has to be recorded as and when it takes place. The cost of this sale has been accounted for correctly in the financial statements for the year ended 31 December 20X8. That's good. Vernon Co has a cost of capital of 8%, at which an appropriate discount factor will be 0.9259. So this is the discount factor that we will use to discount this 8 million sale. So now let's go to our working. I've gone ahead and prepared our notes. So here we have got sales of 8 million, everything in thousands. We are given the discount factor as 0.9259. So come here and say 0.9259. If we discount that, we'll say 8 million multiplied by the discount factor, we get revenue of 7407. This is the revenue that Vernon Co was supposed to record, but we are told here Vernon Co only recorded 4 million. So we have to come here and subtract the 4 million, which is 4,000, and add the correct revenue of 7407, like that. Again, we have discounted this 8 million. So at the year end, 31 December, there will be an unwinding of discount. We are given here, we are told here the cost of capital is 8%. So we have to unwind this by 8%. We say the discounted sales revenue multiplied by 8%, like that. Then we get 593, but 593 is we have unwinded for the whole year, but the sale took place 1 July. So we have to unwind from 1 July up to 31 December, which is 6 months. So we come here, we also multiply by 6 divided by 12. We get 296. This 296, as I said, this sale needs funding, so it's an investment. So the 296 will be added to investment income. So the journal entry will be to debit the receivable and credit investment income. Now we are done with note number 1. Let's go to note number 2. Note number 2 says Vernon Co also sold goods to an overseas customer on 1 December 20X8 for 12 million chromites. They agreed a 60-day payment term. No entries have yet been made to record this sale. Although the goods were correctly removed from inventory and expensed in cost of sales, the amount remains unpaid at 31 December 20x8. At 1 December 20x8, the rate is 6.4 chromides per dollar. 31 December is 6 chromides per dollar. They have given us these rates so that we will be able to translate our sales at the date of sale and also translate our receivable at the date of reporting, which is 31 December. So now let's go and do just that. So under note number 2 here, we will say 1 December 20x8 the sale is for 12 million, of which is 12,000 in thousands. At 31 December, it also remains unpaid, so it needs to be translated again. The receivable needs to be translated. The rate at 1 December is 6.4. 31 December it's 6. So let's go here and say the rate is 6.4. December it's 6.0. Like that. So now we translate 12 divided by 6.4, we get that much. We also say 12 divided by 6, we get this. So we need to record the sale at the date of sale of $1,875. Why are we recording this? We are told here that no entries have yet been made to record this sale, although the goods were removed from inventory and expensed in cost of sales. So these goods are not in inventory, the cost is now sitting in cost of sales. So the sales and the receivable part hasn't been recorded. We are now recording it. So we'll debit the receivable and credit the revenue. So credit the revenue by 1,875. Come 31 December, the receivable has increased from 1,875 to 2,000. So the receivable has increased by $125. So now it's a gain. We have to debit our receivable and credit, not revenue, and now credit our operating expenses. We've done with that note. Now let's go to note number 3. Vernon Co acquired 9,000,005% bonds at par on 1 January 20x8. The interest is receivable on 31 December each year. So Vernon Co has acquired these bonds for a year, as he has acquired at the beginning of the year. Vernon Co incurred 0.4 million broker fees when acquiring the bonds, which has been expensed to operating expenses. This was wrong. The broker fees were not supposed to be expensed, but were supposed to be capitalized. As these bonds are assets, so this 0.4 was also supposed to be capitalized. So Vernon Co was supposed to debit the bonds and credit the bank, but now what did Vernon do? Vernon debited the operating expenses and credited the bank. So now we have to reverse this 0.4. Let's go to operating expenses and reverse the 0.4. Our operating expenses here. The 0.4 million is simply 400,000. We reverse the 400,000. Now let's continue. these bonds are repayable at a premium, so have an effective rate of 8%. Vernon Co has recorded the interest received on 31 December in investment income. Now Vernon Co has recorded again the wrong value as investment income. We'll have to reverse that and record the correct figure. Now let's do our workings. Go to note number 3. It's bonds acquired. Cash paid for the bonds is 9 million, which is 9,000. The broker fees that were supposed to be capitalized, it's 400. When we sum this, we get the opening balance of the bonds as at 1 January 20x8. Now we need to increase the value by the investment income. We'll use the effective rate of 8%, so we'll say 8% multiplied by 9.4, we get 752. Then we have to reverse the installment that was paid. The installment are paid at nominal value. So it's 9,000 multiplied by 5%. 9,000 multiplied by 5%. We can sum that to get the balance of the bonds as at 31 December 20x8. Now, we are told here, let's go to the note, that Vernon Co has recorded the interest received on 31 December in investment income. This is wrong. Vernon Co has recorded the 450. So we are going to go and reverse the 450 and put the correct investment income of 752. So we go to our investment income here, we subtract the 450, then we add the correct one, 752, like that. We are done with that one. Now let's go to our question again. Note number 4, we are told during the year, Vernon Co revalued its head office for the first time, resulting in an increase in value of 12 million at 31 December. Deferred tax is applicable to this gain at 25%. So we are going to record the gain on investment. This gain on investment, we are going to record it in other comprehensive income, but we are going to record it net of deferred tax. So let's do that. The gain is 12 million, which is 12,000. The deferred tax is 25%. So we are going to record the gain net of deferred tax. So the gain is 12 million, which is 12,000, less 25% multiplied by 12 million. So we are going to record this net of tax. Let's go again into our question. Note number 5. Vernon Co values its investment property using the fair value model. The investment property increased in value by 4 million at 31 December 20x8. If he is using the fair value model, it means he is valuing this investment property, the gains and losses, taking them through profit or loss. So this gain of 4 million will be investment income in the statement of profit or loss. So we'll come here and add 4 million, which is 4,000, like that. Now, let's go back to the question. Note number 6. The tax figure in the trial balance represents the under or over provision from the previous year. We have already dealt with this 130 as an under provision. That will be an expense in 20x8. The current tax liability for the year ended 31 December 20x8 is estimated to be 3.2 million. So let's go and add our tax here of 3.2 million, which is 3,200, like that. Let's go again to our question. Note number 7 relates purely for part B, the calculation of earnings per share. So we have finished with our notes here. What is left is for us to add across our statement of profit or loss. So simply say 75,350 less 4,000. We add the correct revenue. We also add that. The cost of sales didn't change, so put our cost of sales like that. Then we calculate our gross profit. Operating expenses, we have got 20,640, of which we have to subtract from that figure 125 and 400. Then our investment income, it's an income, it's 1520. We add 296. We remove 450. We add 752. We add 4 million. Our finance cost didn't change. Then we sum to get the profit before tax, like that. Then we subtract tax on that figure. Then we have our gain on revaluation, net of deferred tax. We get 9,000. Then we add with the profit for the year. We get our total comprehensive income is 21,845. That's how you are supposed to be approaching these exam questions. Not all notes will be requiring workings. Like in our case, note number 4, 5, and 6, we didn't have to have a working for that one. It saves you a lot of time in the examination under pressure. So please watch my video time and again. I will also add the chapters in the description below. Please like it, subscribe, and share. Thank you very much.